Let's get into options, though. I want to mention futures are an interesting thing. If you look at what's going on in the futures market right now, oil futures are doing some amazing, incredible things. A barrel of oil is going about 20 something bucks, but oil futures are down to $6. And when you look at FinViz, it really is. I can't explain. The futures that mature today, yesterday were trading for negative $37. I don't know what that means for oil to trade for negative $37. You can see the longer futures, which is what this is showing, are still ridiculous numbers. $11 for WTI, and I know this is my expertise, but there's definitely some storage issues here. More oil is getting produced than we're consuming because of COVID-19. Storage locations are just tapped out. We don't know where we're going to put all this oil. Some of it's probably just sitting in tankers with no place to go, no place to get rid of it. So it's almost like, if you had some acreage in central Texas, maybe you could buy 1,000 barrels of oil and just store it on your farm. We talked about the storage costs. So if you have a lot of land, you can just store it there without any cost. But the issue is, what do you do when oil prices go back up to normal? But it's been pretty amazing. You look at this, these numbers, just in the last few months, we've gone from 60 bucks down to 11 bucks. That is just absolutely incredible. You look at even longer term, we saw a huge drop back in 2008, 2009. We're seeing something comparable now going on here with oil. Pretty amazing stuff going on. And it gets confusing because you have the spot market, you have the futures market. With the futures market, you have several different futures. So you can see here they're showing oil at $6.16. Here they're showing oil at $11. We've never seen that kind of radical difference. So, we talked about storage costs, and the cost of carry. Right now, that's not what's going on. Right now, it's an issue of supply and demand and storage, and there's a lot more going on than the normal market. So it's been pretty amazing to see this. I wish I could explain that. That's not my area of expertise, especially commodity futures. But boy, we're in the middle of something that it's just completely unheard of. Pretty amazing. But let's get into options. There are options on oil and other things as well, so we'll talk about that. But an option, unlike a future, remember the future requires you to buy or sell something in the future. An option gives you the right to buy something. We call that a call. Or the right to sell something. We call that a put. At some future date at some stated price. The stated price is called the strike price. We'll get into that here a little bit. The future date is the expiration date. So does the right to do something have any value? So let's look at Apple. Here's Apple's. Oh, I meant to do Apple. Here's Apple stock, and I'm going to click over here on options. And so Apple obviously has a lot of options. The stock's currently trading for about $270. Let's go out a few months. So the expiration, let's go out to, say, July 2020. If we go out to July 2020, we have some options to buy. So these are call options. This first part is the call options. So call options maturing in July. So essentially, you have the right, sorry, you have the right to buy Apple by July something at a date, at a price that's called the strike price. So here's the strike price. So if Apple's trading for about 270 bucks, is there any value to buying Apple for 287 bucks if it's currently you can buy for 270? Let's make sure I got the right expiration here. Yeah, flip back to April. I could tell those option prices did not look right. So let's switch over to July. So you have a job between now and July. if you have the right to buy Apple for 285 bucks. Right now you can buy it for 270. Why in the world would you pay to have the right to buy Apple for 285 if you could buy it for 270 today? So it doesn't make any sense. But in fact, it's $14. Why would you pay $14 for the right to buy Apple for 285? Why don't we just buy it today at 270? And the reason for that is if you buy it today at 270 and it drops to 250, you lose 20 bucks. But if you buy the option today at 14 and it falls to 250, you only lose 14 bucks. But if it goes up to 300, you make 15 bucks because you have the right to buy it at 285, but it's really going for 300. So you can buy it at 285 under your option, sell it for 300, you make $15. That's not as good of an example. If it went up to 310, that's $25. You made $25. You only had to pay $15 to get it. That's a really good return. Versus if you buy it for 270, it goes from 270 to 305. Yeah, you made $35, but you had to pay $275 to get it. So what you get is a very levered return. If the stock jumps up to 310, 320, 330, you're making an enormous amount of money having only invested $14. So that's the call option. You notice the call option drops as the strike price gets higher. We'll talk about that. Then down below the call options are the put options. So if you have the right to sell Apple for 250 bucks, can that possibly have any value whatsoever if you can sell it for 270 today? And yet look at that option, it's going for $15. People are willing to pay $15 for the option to sell Apple stock for $250 when they could sell it for $270 today. So we'll see as we look at the payout patterns and these options why people are willing to spend so much money. These option premiums are pretty high right now because volatility is pretty high. So this is probably maybe 50% more than normal. Probably before COVID-19 happened, these options were probably for less than half the price, probably $6, $7. So, you have to look at this and try to understand what is the market telling us with these prices. So there's a high probability that your option that you buy will expire worthless, but you have a decent probability that you'll make a huge fortune. I've had options that I purchased that have been up 40,000% just in a few days. Pretty amazing thing. I had some options I bought just not too long ago. I paid $200 for them in total, several options, and they were trading for $12,000, $13,000, $14,000 a few weeks later. I mean, it's pretty amazing how skewed. You look at that return, $14,000 for an investment of $200. Those are some pretty good returns, pretty skewed returns. Granted, most of the time that $200 will be worthless, and I'll just write them off as worthless. But every once in a while, making $14,000 when I only invested $200, that's a pretty good payoff. It's a very skewed distribution. Your probability of making money is very, very low. You might probably only 4 or 5% chance that you'll make money. But when you make money, you make a huge return. All right, so we have a little bit of jargon here. We have that future date that you can buy something. That's called the expiration date. The stated price, you get to buy it out. That's called the strike price. So we'll put a few terminologies in here. We do know that the price of Apple stock that the option is on, that's called the underlying. We talked about that earlier. So that's the underlying stock price. So where in the world did we get this $15 for the put option, the right to sell Apple for $250 when we could sell it for $270 today? There's a break between $265 and $270. Where did that $15 come from? What drives that value? And then we looked at $285 and we saw that's $14. Where did that $14 come? The right to buy Apple for $285, where we could just buy it for $270 today. Now we have the right to buy Apple for $285 over the next 3 months. This option expires in July. That's the expiration. 285 is the strike price. This is the premium, what we're paying for the option. Where are all these numbers coming from? And so one of the things we have to know, I used to ask this on the exam, but I now since everything's open book, there's almost no reason to do that. But you should still know this. I would know this. You should learn this. This isn't something to memorize for an exam. This is something to know the rest of your life. This is just one of those things, and I've tried to set it up so that you can remember it. So what determines that $14 for the call option on Apple, or that $15 for the put option on Apple? And what we've come up with previous classes, we have this mnemonic, and we call it Texas Video. Think of Texas Video and TXSVID. So T is for time, X is for the strike price, S is for the underlying price of whatever the call or put is on. So like we're looking at Apple is worth 270, so that's the S. V is the volatility of the underlying security, the volatility of Apple's stock price. I is the level of interest rates, and D are the dividends that the underlying stock pays. So Texas Videos. So what you need to know is what these things are and how they determine option prices. So the T is the strike price. Now, I've seen some formulas where they don't use T, they use K. So it depends, are you a bowler or are you a baseball player? So a strike in bowling, we put an X. A strike in baseball, we put a K. And you'll see both of those. So one thing you might look up in Google is do the Black-Scholes option pricing model and put Wikipedia in there. And if you do Wikipedia, they'll give you the formula. It's a fairly simple formula. I've had it memorized at the time. I don't have it memorized today. But here's the formula. So it's not that difficult. It's very easy to set this up in an Excel spreadsheet pretty easily. But you notice for this formula, they use a K instead of X. I use X, they use a K. So they use the other things I use. So they use S for the price of underlying security. So Apple, we said 270. They use T for time. They use R for interest rates. They use sigma for volatility. So yeah, T is how much time is left. You know, the T, big T and little t, that's just the time to maturity. So they use a T for time. The D's are simply distributions, the normal curve. It just shows you the probabilities. So E is a function for continuous compounding. So some of these things are just things you see in other formulas in finance. So so this is not that difficult to set up, and everything I just mentioned is in this formula somewhere. So this Black-Scholes formula is the formula for the price of an option. That's why everything I mentioned. So Texas Video. So T is time, X or K is strike price, S for Texas, that's the underlying security, video is volatility, I is interest rates, and the one thing that's not in here is the D, which is dividends. The Black-Scholes formula, this is the Black-Scholes formulas without dividends. There are formulas, you'll see down here that they'll probably give you other formulas where they show you how to handle dividends and put that into the equation. But dividends do affect option prices. The other place you can go, which I really recommend, is www.cboe.com. That's the Chicago Board of Option Exchange. They have a lot of free educational stuff that I recommend. I mentioned this earlier in class, blogs and podcasts. But if you one of the things you can do is tools and resources. They have calculators. These calculators, if you look at that, you have an option calculator. And essentially what this is the Black-Scholes model set up. And they do it as an American option, which is what you want to use. This is what we're doing. European options are a little bit different. You can put the price of Apple, 270, the strike, 285, days till expiration. So it was July. So we got May, June, July. I'll just say 90. I'm not exactly sure. The underlying volatility of Apple, I'm gonna guess 50%. Let them put the dividend and the interest rates in their dividends. I don't know when the dividend date, so I don't know that. Then you calculate it, and they get an option value $20. Remember, for us it was $14, so my volatility is probably too high. Let me try 40 and see if that gets us closer. $15. So it should get you something similar. I've used an option pricing theory model like this when I was at UTSA because we were hiring executives who worked for firms who had options in their contracts, and they needed someone to figure out how much would those options be worth. And so I used an option pricing model to tell them, to give some sense of what those options would be worth. But anyway, so if you look at CBOE, you can actually do some calculations yourself. The other place you get on CBOE is, if you go back, they also have an option data, and they have delayed quotes. You can see the delayed quotes. We saw this on Yahoo Finance where I showed you option quotes. I trust CBOE more than I trust Yahoo Finance. So when I get my quotes for options, I usually go to CBOE and get my quotes there. And if you put in, I do the SPY option quite a bit. If you do SPY, they'll bring up the options that are available. I have an option that matures in May, and I want to see all. And so when you look at these options, it's a call option that I sold. It's a naked writing on my call option, and so you can look down at the options. Mine was a strike of 190, but it's wasn't on May 1st. It was further down. So they give the expiration date. If you look at it, the expiration date 5/4, the strike, and you figure out what your option is. They even give you delta and gamma, and we'll talk about some of these other things in the formulas. My option should be down in price, which is great today because I sold the option, so I want it to be down in price. So it gives you all the information you need. It's pretty amazing. And they show the outstanding interest. And I've had some times, and it made me a little bit nervous, but I've had times where I was 100% of the outstanding interest. There was not one option I've been rolling forward, and I only had 3 of them, and the number here was 3, so I knew I had that entire option. Makes me a little nervous, but it was fine. It didn't. I wasn't getting ripped off or having problems selling it. These are pretty liquid securities. But anyways, so that's what we're going to look at with how to determine the price of an option. So what we'll do in the next session is I'm going to walk through each one of these. What you need to know is what is it and how it impacts the option price. So 2 things: what is it and how it impacts the option price. So we'll leave that to the next session.